think the hard part is understanding that there are better ways now in the economy, different, the economy has different strategies, right? That we have different points of time in history and different points of time in the economy where we can take advantage of certain opportunities, whether it's interest rates, whether it's, maybe a market downfall, whether it's, maybe a recession, right? So all these different things, you should be able to change your portfolio depending on, right, different economy representations. It shouldn't be just a one size shoe fits all. And I think we all know that in the back of our mind, but we can't really bring it up, right? So what your question was, Jim, was, should that fixed index annuity now, right, come into that bond proportion? And absolutely, it really can. And there's a lot of reasons why. One reason is if you've gotten a bond portfolio and you've averaged, what a regular bond ETF or a bond mutual fund has done compared to some of these fixed index annuities right now, the percentage rates change, right? And they're outperforming the bond market. I mean, in a lot of different cases. Now, it depends on which fixed index annuity you're going to sell and, which one fits a client's need. I think the annuity gets such a bad rep out there because of the big bad word, because of the fees and all the 9 yards. But really, when interest rates increase, right, it increases the fixed index annuity world, it increases the annuity world. It makes annuities more advantageous for the client, just like bonds, right? When interest rates increase, you want to get into a bond because maybe you get a higher interest rate, okay? And that works the same way, right, with a fixed index annuity. So I think that, obviously with these competitiveness of companies coming out with income products that are paying out a substantial amount, right? Or even, with market link growth, right? It's not guaranteed growth, but you have, market link index growth, right? Let's say you have a cap of a certain percentage for 9 or 10%. You can get that percentage change in that market that year without any risk, right? And that brings a big side of the portfolio that we don't see with the bond market, right? Because the bond market's a fixed interest rate, right? So I think that the number one thing people have to understand out there is that we have to get away from what used to be the old terms. And I think everyone's kind of realizing that those portfolios aren't producing what they need, right? They're not producing enough to give someone the retirement that they actually want, Jim.
Who is the right fit? Just kind of generalizing here, the right fit for a 60-40 portfolio.
I don't have that answer, Jim. I don't have that answer. And I think it's a 60-40 portfolio is I don't think the right answer for anyone. I think that everyone has to have their certain goals, what they're wanting, what they're needing. I'm not a big bond fan. I'm just not. I do not like bonds, Jim. So to talk about a 60-40 portfolio, to put 40% of your money into bonds is just, I think, settling short. Mm-hmm. I think it's not doing what it needs to do for the client. And I will stick with that into the day I die. I'm not a bond guy, just like Warren Buffett. I mean, Warren Buffett hates bonds. I'm not a big firm believer when the mathematics show bonds never win. So if you have bonds in your portfolio and you're thinking to yourself, David, why do I have them in here, right? What's the alternative? Give us a call. I would love to sit down with you because that's an easy conversation. So really, I have that conversation every day. This morning, I had it with 3 different clients, right? Or prospects that are now, joining my advising. So I think that a lot of the times people are always looking at what they could have or what other people did or trying to, copy other people's strategies. When they really should be doing is they should find an advisor that is able to innovate and look at new strategies that are in the now, that are in the economy right now, that with the AI boom, with, different tech stocks, maybe at a lower price level, with price per earning ratios, with companies they can buy, with different alternative products, with fixed index annuities that can maybe give them an 8% return that year without risk, right? And that's not guaranteed, obviously, but, if the market goes up, you get that market link growth, right? So I think people are so stuck on one side, they're not opening their mind up. So if any of you out there have that process and you're thinking to yourself, David, how do I switch up from the bond mentality? You're right. I see it. My portfolio is not producing what I think it should produce. Give us a call. We'd love to help you out.
The 60-40 portfolio earned its reputation because it was built on a powerful concept diversification, but the allocation itself was never meant to be a one-size-fits-all solution. As your life changes, and especially as you move into retirement, your investment strategy should reflect your current goals, income needs, and risk tolerance, not simply a formula that's been around for decades. Again, if you have any questions or would like to get started on that retirement portfolio analysis, visit us on the web at retirementplanningpipeline.com or call 850-565-1705.